Okay, great. So we're letting the attendees trickle in here. Welcome everyone. We'll give it a little bit less than a minute, and then we'll get started here. We're right on time. All right. Good. Seeing that attendee list pop up. Okay, so let's get started. My name is Jeff Gould. Good morning, everyone, or good afternoon, wherever you're attending from. We appreciate you coming in today and joining us. Today, we are going to talk about estate and tax planning strategies for closely held real estate owners. I am Jeff Gould. Like I said before, I'm the incoming president of CCIM Los Angeles, the Greater Los Angeles chapter, and also the fiduciary co-chair. Along with my co-chair, Peter Lawson, we want to welcome you to this webinar, informative webinar today. And we're going to go into a little bit of what our agenda is today. I'm going to give you a little introduction. We have a number of participants that may not be familiar with CCIM, so we'll go into that real quickly. And then we'll launch into the presentation, the biographies. We're going to talk about some really interesting case studies and then go into Q&A as well. And then we'll provide follow-up contact information for everyone. So this presentation is being recorded. So we will send out the recording after the presentation for anyone who can't attend. But I want to let everyone know that we will have the opportunity for Q&A at the end. And the Q&A, what I recommend for everybody, if you do have questions, feel free to type those questions into the Q&A box in your Zoom link or in your Zoom menu. And we will answer those questions or aim to answer as many of those questions at the end. And if we have a number of questions, we're free to spill over a little bit over the top of the hour as well. So with that, I want to thank our fiduciary committee sponsors, which includes our gold sponsor, eXp Commercial, and Lineage Asset Advisors, and then our silver sponsors, Clumex Stern, Crost, Northern Trust, and Truist. Thank you all for sponsoring and participating. So real briefly, for those that I know we have a number of people that are on the call that are not CCIM members or maybe not familiar with CCIM. CCIM stands for Certified Commercial Investment Member. It's been a designation in the commercial real estate industry that it really is the gold standard. It's been around for over 50 years and includes the likes of real estate professionals like appraisers, asset managers, brokers, developers, investors, lenders, and other allied professionals. And really CCIMs, those who have the CCIM designations have completed a rigorous coursework and training around financial and market analysis and have demonstrated extensive experience in the commercial real estate industry. So would definitely want everybody who wants to be involved in CCIM to let us know, and we're happy to take you through what the curriculum is. It's taught by really extensive and professional instructors. Today, the CCIM continues to guide growth of nearly 8,000 professionals each year. So we have a really great dynamic list of CCIM professionals and designees throughout the country and even internationally. Again, who we serve, investors and investment counselors, all the way through to asset managers, brokers, appraisers, corporate real estate executives and property managers, developers, investors, lenders, portfolio managers, attorneys, and bankers. So what we've aimed to do with our fiduciary committee is really attract and try to build our network around related fields, related professions in the estate planning, accounting worlds that are related to the real estate industry in many ways, and talk about the unique issues that arise with fiduciaries in real estate. So again, our mission at the CCIM LA Fiduciary Committee is to provide education, networking, and guidance around the complex topics of real estate wealth transfer and the fiduciary's role with investment real estate assets. And like I said, we're comprised of many different corporate fiduciaries, private fiduciaries, family offices, real estate advisors, and the like, all who are very involved, and those who are on the panel today who are very involved in the fiduciary real estate world. So what we offer, so today we're offering these free educational webinars. We would encourage you to get involved with the CCIM LA committee, to be more involved with our fiduciary committee and our other committees. And we offer, again, education and networking opportunities fiduciary related resources, and we would encourage you to become a sponsor and get more involved in our committee. I want to just give everyone a little taste test of some of the education that we offer. Coming up here in our region, our greater Los Angeles region, we have the wonderful Susie Jones Walker, who's one of our esteemed instructors, who is teaching a course on commercial real estate negotiations in Los Angeles, and that's coming up on November 4th. So we'll send out this PowerPoint presentation to everyone after the fact, and it'll have links to enroll in these educational seminars. We have our CI 103 course coming up, which is a user decision analysis course for commercial investment real estate. And that course is on November 5th through 8th. So I would encourage anyone who is interested in getting involved in the CCIM education to enroll or let us know if you have any questions. And then on the last piece that I want to promote is we have our 28th annual installation luncheon coming up at Lowry's Prime Rib in Beverly Hills on Thursday, November 14th. We have a wonderful presenter on the LA 28 Olympics and the implications of the Olympics on the real estate industry and the economy in Los Angeles. So I would encourage everyone who is interested to let us know. We're going to have a link up to register to that shortly, but please do let us know if you have interest in registering. It's going to be a great event. I want to thank our CCIM LA Fiduciary Committee Executive Board for being involved and helping us put on these great events and these great webinars. So thank you to you all. And I will give you the link to become a CCIM LA member and to get involved as a volunteer. We are a 501c3 nonprofit, and we encourage all of you to get involved and help us better the real estate education, better the network here in the greater Los Angeles region. So with that, I want to swing it over to our wonderful panel, and we'll start out with Charles Wilson, our moderator on this panel, to kick it off. Thank you, Charles.
All right, thank you, Jeff. Hello and welcome to today's seminar, everyone. My name is Charles Wilson, as Jeff mentioned, and we have three esteemed presenters here today. We have a CPA, Scott Grimm. We have an attorney, Della Ronan, and we have an asset manager, Andrew Fetter. And before we get into introducing the three of them, I'll give you a little bit about my background. I was recently pinned as a CCIM in Seattle this past October 2023. And my background, I'm an MAI and MRICS designated commercial real estate professional with over 20 years of experience in advisory and valuation of most investment grade commercial real estate asset types and many special use property types. Currently, I'm the lead professional on our West Coast with BDO's National Real Estate Advisory and Valuation practice. My former employers include work with real estate advisory practices Altus Group and Houlihan Lokey. And I did work for a number of years as a deputy assessor with the Los Angeles County Assessor, which is kind of where I cut my teeth on valuation. So with that, I want to move on to introduce our first panelist. I want to introduce Scott Grimm. Scott is with BDO, and he is the private client service tax practice market lead located in Denver. Scott, please share a few words with about your background with the attendees.
Yeah, so I've been working in public accounting for almost 25 years now. Through that period, I've worked almost exclusively with real estate clients that include owners and families that are involved in real estate businesses. Very much focused on the middle market. As a firm, BDO can service even from startup developers all the way to public REITs. So very broad range of reach that we can provide services to multiple clients within the industry. My background really focuses on middle market. So again, closely held, maybe investment groups, but usually in a flow-through model. And we almost exclusively also serve the families behind these entities as well.
All right, great. Well, thank you so much for that, Scott. And our next presenter that we're going to introduce here is Della Ronan. Della is the managing partner and estate planning attorney with Ronan Private Wealth. Della, please share a little bit about your background, please.
Thanks, Charles. Hi, good afternoon, everyone. I'm excited to be here today. A little bit about me. I've been a practicing estate planning attorney for about 10 years now. And I started off at Venable, where I worked on very complex, high net worth clients and built a book there. I recently opened my own office about a couple months ago here in Beverly Hills. I've dedicated my career to helping individuals and families secure their legacy through strategic planning, particularly those with closely held real estate portfolios. And what makes the unique aspect of estate planning for this type of work is that we're oftentimes not just dealing with managing wealth, we're also preserving and growing their assets and dealing with family dynamics. I'm excited to be here and I look forward to speaking with everyone on the panel.
Great. Thank you, Della. Yes. And last but not least, we have Andrew Fetter. Andrew is the Managing Director, Head of Real Estate Advisory with Bessemer Trust. Andrew, please share a few words of insight about your background.
Certainly. Thank you, Charles. And hello, everybody, and good afternoon. I am Andrew Fader. I am the head of real estate advisory at Bessemer. And our primary function is as a trustee or executor, and we manage an extensive book of investment real estate and other real estate in that capacity. My background is as a real estate broker. I've been licensed for about 35 years now. I cut my teeth with Jones Lang Wooten in real estate investment banking and went on to be a commercial asset manager through most of my career.
Great. All right, Andrew, thank you so much. So with that, let's jump into our subject matter for today, estate and tax planning strategies for closely held real estate owners. As a panel, we want to discuss and introduce a concept of holistic approach to coordinated estate and tax planning and understanding its impacts as it relates to situations of transition for families with real estate holdings. So what we've done here is we've assembled the key roles of a fiduciary team, and they are all represented here today on our panel. So let's hear from each of them regarding the significance of their role and the coordinated interaction between the various team members. Della?
Yeah,
as an
sure.
attorney on a fiduciary team, yes, you're also often the initial point of interface for a lot of these families. You want to share some insights on these situations?
Yeah, definitely. When it comes to estate planning for large real estate portfolios, it's pretty crucial that we understand the broader impact of the transition. These transitions are not just financial, and for a lot of people, it's emotional and it's about legacy. And for many families, real estate represents a legacy of hard work and investment. And a failure to kind of plan adequately oftentimes leads to unintended consequences. We're dealing with like probate delays, liquidity crisis, and even forced sales for properties they might really cherish. To ensure these, it's always great to have this idea of a holistic approach where all these different key roles play together. With me as an estate planning attorney, I have a strong focus on the drafting and the structure of the estate plan. It ensures that everything complies with the law while maintaining the estate tax benefits and protecting the assets. And we're also always making sure that we are ensuring that the client's wishes are fulfilled. And sometimes those are personal and family values in addition to the financial values and the need for maintaining legacy.
Excellent, excellent, yes. So, Scott, Andrew, just want to kind of unpack this a little bit more. And, from an ideal standpoint, please share some insights of how a fiduciary team's integrated strategy can provide long-term success for real estate families. And it'll be great to also discuss best practices. So let's spend a little time kind of talking about that, please.
Yeah, so I'll start, and oftentimes and again, very broad stroke, but the role of the CPA often can be overlapping across all these different areas. I mean, CPAs generally, assuming they have long-term relationships with these clients, have purview into not just the businesses or the portfolio, but also the individual and the family level when it comes to tax or even assurance. I mean, there's lots of integration that happens within the CPA world based on that relationship. So it's a key part of the team with regard to, when you're rolling into estate planning or just overall tax planning. But that relationship with, as Della said, with the attorney and the asset manager is crucial. Oftentimes the CPA can be the source of documents, the source of historical data that goes into all of these planning opportunities that we'll be talking about today. But it's very much overlapping and many times can go back, multiple generations as far as those relationships go. So very important part of the process.
Andrew?
As a corporate trustee, we're often charged with looking at complex real estate portfolios and seeing how you preserve them for future generations and make them live investments. To do that, it takes an enormous amount of coordination, both with the family to understand the aims and wants of the family, and also with counsel and accounting and other to ensure that there is both the liquidity and the ability to hold these assets over time. One of the things that often gets missed, looking at all the various entities that are involved in holding these assets and ensuring that succession planning within those entities is coordinated with the estate planning for the principals.
Great. And I did jump ahead a little bit here. So, so now that we've got an introduction of the roles on the fiduciary team, let's talk about some integrated strategies for long-term success. It'd be great, Scott, Della, Andrew, to just unpack that a little bit for our audience here and before we jump into our case study.
Yeah, the planning that we're talking about today, a lot of it has to do with, ongoing multi-generational issues that can minimize estate tax, obviously, but also have to do with ongoing operations of the business, as Andrew mentioned. So for long-term success, again, it does take a very synchronized team that can communicate with multi-generations, that understand what the rules are based on the estate plan, based on the business plan, that can see that these plans are actually integrated and followed throughout the timeline of the business. So again, very important from that standpoint of making sure they are synchronized in a team effort going into it.
And I mean, to add to that, I think one of the best practices that I've seen
And a lot of go ahead, Tim.
I was going to say something that I've seen that has worked for my clients is kind of like how we have right now is kind of having those key roles and those key fiduciary team be very much in touch with each other and working on everything cohesively on the same kind of email trends and just on the same platforms so that the messaging amongst them all is not got lost and there isn't this need to consistently keep reaching out to different people.
Andrew, you were going to share something?
Yeah, just again, echoing the saying that the coordination of effort is key. Some of this also reaches past the professionals and into the family's business. Very often there's an operating company with the assets themselves. And the considerations around that company are really quite pivotal in terms of how the success or lack of success of the planning can go. So for the purposes of this, we're going to think about mostly the assets themselves and not the operating business.
Okay, great. All right, so with that, let's move into our first case study to illustrate a real life scenario for a family-owned real estate company. Our first case study is a family who is a real estate company with substantial holdings, but they have not really done any significant estate or tax planning. Della, I'm sure you've seen these scenarios before. Please give some context to families on these situations, and open up the discussion with the rest of the team
Yeah.
about how you all would work together on this.
Yeah, so this is more common, unfortunately, than I would hope. I have lots of clients who had these huge portfolios, and I actually recently had just one client who just yesterday I was speaking to him, and he has 67 different properties and LLCs, and he doesn't even have a revocable plan. So just the scariness of this is huge. When I start working with these families, the risks are usually very high, and the families are usually unaware of how vulnerable they really are. Um, in this case, we have a family that hasn't prepared anything, and we know that or I know maybe, but I'm telling this to everyone else, the estate tax exemption is set to drop unless it changes to around 6 million by 2026. And without planning, up to 40% of their estate above that lower threshold could be taxed at that 40% rate. And this means that above that 6 million, nearly half of the family's wealth could disappear, and it could severely impact the legacy they worked so hard to build. Um, Similarly crucial is the succession planning. If there's no clear path for who's going to manage or own the assets when the current owners pass away, it causes huge disputes among these families who maybe were so close, but now money is a major problem. And in family businesses, these disputes, they become, of course, emotional, and they tear up their relationships. And I've seen all kinds of unfortunate circumstances. Um, Again, another crucial concern is asset protection, of course. With any real estate, if it's held in your personal name or structured incorrectly, you're exposed to creditors, divorce, litigation. I mean, the list really goes on and on. And families often don't realize how much is at stake until it's a little too late, and they leave the future generations very vulnerable. Fortunately, I think Scott and Andrew are going to give us a couple strategies to mitigate these risks.
Yeah. So,
As I-
you know,
as I-
go ahead,
as I
Andrew.
noted before,
Go ahead, Andrew, please.
As I noted before, one of the things that special attention needs to be paid attention to is succession planning within the entities in coordination with an estate plan as it is crafted. Very often, principals will have a partner, and as they start out in business, they will maintain it over many years. And the succession planning at the time was, if one of us has something to happen to us, the other one will take charge. Who's named in that doc may not have been revised over many years. There may be control issues which may impact the inherited value, and there also may be incomplete succession planning within the document, since both principals were active and alive in the business, but the other principal, not the partner who we're contemplating as the GP right now, may not even be alive. And so in a coordinated effort, you should go back into every entity and ensure that there is clear succession planning and understanding of control.
All right, great. Thank you, Andrew. Scott?
Yeah, just from a structure standpoint, getting an idea of how these assets are held, in what entities, where the opportunities are, and where the risks are. It can be widespread. Most families that own a lot of real estate are held in multiple entities. So you can have different rules for each one of these, or outside investors. So from a mitigation standpoint on these issues, whether it's estate tax or income tax as they go, really just getting a handle on where they're at today, where things are, what the rules are, where the limitations are from a planning standpoint, and then working to identify the low-hanging fruit, I'll call it, from a transfer standpoint. You know, there could be some assets that have personal guarantees, that have debt covenants that make them more of a challenge. So that initial assessment of what the portfolio looks like, what the holdings look like, the entity structure of the family group, and who the owners are, I think are a great starting point to jump in to help mitigate, you know, again, those exposures to estate taxes being one of them.
And I just to add from the estate planning perspective, so we're looking at the pre-sunset gifting, for example. This is something that I'm doing often now with clients, which is pretty much using some of that exemption amount that they have for a lifetime now, and thereby reducing their overall estate size while they're still alive. You know, that's locking in the tax benefits and pretty much making it a guarantee that we're not going to lose that amount even if there's a sunset. And just to again touch on that liquidity planning, that's also major problem oftentimes for my real estate clients because performing assets, they have an issue with having cash to fund those. And sometimes I have clients usually I have clients who use their life insurance to cover those kinds of issues and to cover and to cover estate taxes so that there's no forced sale of valuable properties.
Yeah, I'd probably just to add on to what Della just said there too, you know, over the next, you know, by the end of next year, so the next, I'll call it 15 months in front of us, for clients that haven't done any estate planning, this is so crucial. You know, we all work with a lot of high net worth individuals that own substantial amounts of real estate. And even with the exemption as it, you know, on its own, you know, that cut down of, you know, call it $13 million by the end of next year, that represents a substantial amount of money to these families, even if they're well above that as far as net worth goes. I don't run into too many clients where, you know, a $5 million tax bill isn't material, you know, no matter how big their net worth is. So we are expecting and seeing a lot of activity around this estate planning issue, you know, prior to these sunsetting exemptions at the end of next year. So it's a very hot topic right now in the real estate world, especially.
And I will say for my clients, those clients who
And
fall
also,
somewhere between about I would say 9 or 10 million to about 30. Those are the ones who are going to feel this the hardest. And those are the ones, because if you're any lower than that, it's kind of hard to do some of the planning because you might need that asset in your estate. So you also don't want to, you know, over gift. But to the clients I have that are somewhere between 10 and 30 million, that is the crust of the issue. Those are the people who should really be looking into advanced planning right now, before this sunset issue.
Andrew?
and just to build up to what says, liquidity is a significant problem in assets. If you leave its legacy, that is for the enjoyment, huge leverage, and liquidity around the assets is an important thing to look at. Generally, you'll want to plan to have more liquidity than the principals would have during life to be able to be successful in the ongoing duration of the portfolio.
Excellent. All right, well, thank you all for this. I think we've kind of hit the high points on a lot of these topics here and unpacking this initial and utilizing this initial case study to try to unpack some of this topic for today. And imply here, there are a couple of key points that we want to illustrate on our next couple of slides. One deals with this whole idea of the holding entity that is being used. And I'm going to pass this back to Della again and just ask her to please provide an overview of some of the common types of entities used by families holding real estate and discuss with the other panelists the important considerations that need to be taken in those selections.
Yeah, sure, definitely. So Of course, with real estate, we really need to focus on the type of entities that's going to be holding these assets, and they play a crucial role in the protection and tax planning. So the most common is LLCs or LLCs, limited liability companies. These are popular often because they kind of limit your liability, of course. They take away the personal assets of the owner. They don't let those be up for they protect those and limit the liability. They also allow for flexibility in management and ownership, and they can be set up, of course, as pass-through income so that there's none of that corporation double taxation issues. Next up, family limited partnerships, FLPs. We use these a lot. These are particularly effective for family-owned real estate. They have their tax advantages, and they have something that we use often, which is the ability to apply discounts on the value of the real estate. This can be huge for clients who want to move major assets out of their estate at a discounted value. For instance, they can discount the value of the insurance transfers to the heirs and then lower the estate tax while still maintaining the control over the asset. That's key. We have a lot of clients who sell minority interest to their children, and by doing so, because it's a minority interest, of course, those types of marketable discounts apply and valuation discounts apply. So you could really oftentimes transfer like let's just say like $30 million for somewhere around $22 million worth of your actual amount. Like you would be taking out 30 million when and only it shows as 22. And the last is what I do most, which are these irrevocable trusts. There's so many different types. They are great for protection, great for control. And what's great about irrevocable planning, if it's done right, it kind of preserves the assets for future generations. And assuming that, like we're speaking today, people are well thought out and they're maintaining everything, it can really be a beneficial way to pass assets to the following generation, but still maintain that control and kind of maintain the long-term wealth of the family.
So Scott, importance in the entity selection, the critical elements of optimizing the tax benefits. Would you like to touch on some of that as it relates to these various entities?
Right. Yeah. So generally speaking, and it could be a session that's much longer than the one we're having right now as far as choice of entity goes. But as a general rule, a partnership for income tax purposes is the right choice of entity for most all real estate. That would include limited liability companies, family limited partnerships, LLPs, like those, all of those entity choices, again, for income tax purposes, file a partnership income tax return. As long as they have multiple members, and those are generally the right choice of entity when it comes to holding and operating real property. There's, again, a small handful of exceptions to that, including public REIT, which by nature is a corporation. But generally speaking, again, closely held real estate, you do not want to hold it in a corporate form. It's very rare, but sometimes you'll see or we'll see new clients that come across the firm that have assets tied up in a corporation. It's much more limiting. It's harder to take advantage of basis that's inside those partnerships to actually use the flow through losses as an example that are coming out from year to year. So if you ever do see a corporate form, so a corporation that's holding real estate, I would say immediately that would be something to look at as a little bit of a red flag. It can basically be something that can handcuff you to that form. Again, a lot less flexibility when it comes to income tax and estate tax planning in corporations. So partnerships generally are going to be the entity of choice, whether it falls into an LLC, an FLP, or any other partnership form.
Excellent. Thank you, Scott. Andrew, there's this whole idea around the family and there's goals that they've set for the family and the way they're holding the real estate relative to that. Would you like to kind of discuss a little bit around, how that impacts entity selection? Andrew?
Seems we might have some audio issues with Andrew.
Okay, all right. Well, let's move on to the next slide then. So the other piece that we wanted to touch on, and it was somewhat illustrated in our first case study, is this whole concept around basis, high basis versus low basis. So next slide, please. Yep. So Scott, I think it'd be helpful for our group to give a definition of basis and some examples of high basis, low basis, and discuss with the panelists tax implications, strategic considerations for families holding high basis assets, low basis assets, or a mixture, which is often the case, right? It's a mixture of both.
Right. Yeah. In this context, Charles, I think we're talking about high and low basis being relative to the current fair value of that property. Generally speaking, basis is, whatever they bought the asset for. And if it's depreciable commercial real estate, you would back out depreciation that's happened over time. And that's, in a nutshell, what your current basis is in those assets. So for highly appreciating assets like commercial real estate, if they've held it in a long time, they're generally going to be low basis assets today based on an increase in value over the time that they purchased it. I'd say that the one thing that this is a really important exercise for on basis when it comes to asset transfers, and I'll let Della jump in on this as well. There's a big distinction between whether when somebody dies with assets, generally if they're in their estate, those assets get stepped up, so you get a basis step up to equal fair value. So if the heirs of that, if somebody passes away with an asset in their estate and it passes to the heirs, they would have full basis based on current fair value. So if the next day they went out and sold the asset, they wouldn't pay any income tax. The estate tax issue is different though. So when you're choosing assets as part of an estate plan to transfer into trust, as an example, basis considerations are always very important. If they're low basis assets, they might at face be better to hold within the taxpayer's estate as opposed to transfer them now, so that they can take advantage, the heirs can take advantage of a basis step up in the future. On a gift, it's really carryover. So that's a big difference there. And Della, I don't know if you want to add in anything.
I mean, yeah, Scott, you did that great. I was gonna say exactly the same thing, but this is actually a really good place to remind everyone of why it's crucial that all the different key players work together. Because oftentimes when a client comes to me, they don't have a good grasp of this concept of basis, and I need to speak to who their advisors are to know exactly what assets they want to transfer while they're alive. Because like Scott mentioned, there is a different treatment of basis if you hold on to it and you pass away versus if you gift it away while you're alive. So oftentimes with clients who have big portfolios, one of the key decisions as to what assets we're moving relies heavily on this basis issue. And I'm always asking my clients, okay, let's focus. If you're trying to get the asset out while you're alive to use that exemption amount, I need to know which of your assets have high basis, because those are more suitable for gifting during lifetime. On the flip side, if they have property that they have been, have had for years, you want to make sure, I mean, like I'm talking 20, 30 years, they probably want to hold on to those assets, because what happens is on their death, there's a step up, and it steps up to the fair market value at the date of the death. So what's great for those clients is the inherited property then only ever has capital gains tax on the value between the stepped up basis and then later being sold. So this is a very key part of deciding what assets are good for gifting versus what assets are better for keeping in your estate.
My apologies.
Andrew, can you hear us? Are you back with us now?
I am back with you, yes, in a more stable environment. My apologies.
Hey, not a problem, not a problem. So we're on the slide where we're talking about the high basis assets versus low basis assets. And, Scott has defined that for us, and Della's given some great insights around implications and strategy. It'd be great to get your perspective on this.
Yeah, I mean, again, depending on where you are, but if you're planning for a future estate, you may want to take high basis assets and actually sell them and roll into an exchange to provide a family with long-term income in a less complex asset. It really depends on the family's wants in terms of the actual portfolio that they hold and what their eventual aims are in terms of retained assets over the long term.
Great, great. All right, so we've defined these couple of terms which were implied terms in our prior case study, and just wanted to make sure we had that background as we move into our next case study. And so this next case study, which is kind of unpacks this concept that we're discussing more. It involves estate and tax planning for a family with an aging principal. That is this family has a sizable real estate portfolio. It includes different property types, and these assets have been acquired over, say, the past 30 plus years. As a result, as we just discussed, the assets have varying basis. Regarding the family's estate plan, they have a simple will and a revocable living trust, which was established about 30 years ago as well. The properties are held in the principal's name or jointly with the principal's spouse. Also, they do hold life insurance, as Della mentioned earlier. It's held by the principal to cover any potential estate tax liability for the family's succession. So that's the summary of our next case study that we want to scenario that we want to unpack here. So Andrew, I'm sure this type of situation sounds familiar. Right? I'm sure you've seen this a lot. So provide some opening thoughts regarding how the fiduciary team should approach a situation like this. Do you start with the end in mind? How do you all tackle this?
If you start at the beginning, which is a discussion with the principal and his family, depending on which members are involved in the planning, about how to look at the portfolio overall, and understanding a balance sheet, an understanding of cash availability and liquidity, financing, and really looking at all aspects of the current portfolio. Ideally, what you want to do is you want to understand which properties are the keepers, so to speak, the long-term assets, the ones that are difficult to acquire, difficult to replace, that may be desirable as a legacy, and which assets would possibly be sold, either depending on basis, either currently or in the estate. Once the emotional and investment decision is made in terms of what assets, you work with the whole fiduciary team to understand how to affect a plan. Portions of the interests that are personally held by the principal and his wife, you may want to gift and use, as Della has pointed out, some of the ability to have discounting for minority interests that would allow you to be tax efficient, also move portions of the assets downhill. And look into, as I mentioned, if the assets are held in entities, the succession planning in the entities that should be looked at. If a principal has operating control of an asset in his lifetime, and the succession plan is not coordinated, that asset may actually be valued in the estate as if there was control, and then after death may wind up being a non-controlling interest with control in the hands of whoever is named in the LLC agreement as the managing member. That can provide a real problem because the asset may be at 100% value in the estate and at a discounted value, 100% value from a valuation purpose in the estate value, but from a sale purpose in the estate may be discounted as much as 35 or 40%, which can create a real liquidity problem and threaten the viability of the planning overall through lack of available liquidity and forced sale of assets that the family would otherwise want to keep.
Yes, yes. So thank you for unpacking that, Andrew, because that really kind of gives some context around how, you know, these scenarios can be very involved, right? And so, Della, would you like to touch on some of the missed opportunities here that we have, that we want to, challenges we want to try to address, and then, you know, Scott, the key considerations that we want to deal with.
Okay. Well, in this case, taking it back to the facts that we're dealing with, you know, the first red flag here is that this was planned 30 years ago. Anytime I have clients who have estate plans, even revocable plans that haven't been looked at for 10 or so years, including their simple wills, basic trust, I have to first review that plan and revisit it to make sure that there's no gaps and there's no changes that might be to modernize their most basic of trusts. Also, we're dealing with family dynamics changing. So I don't know if that actually addresses what this slide is, but when it comes to other missed opportunities, we've talked about these briefly a couple of times now, but really a big missed opportunity is using that lifetime exemption and these more complicated gift structures. And again, like Andrew mentioned, we do want to make sure that we can maintain asset protection, but to the extent we can, to use those types of discounts to move assets and move greater amounts of assets at those discounted rates. And the minority discounts are best used when you are transferring during life and giving those interests to your kids. And the great part is they can still be done such that the parent, or the top family member who's involved, still controls everything, but it is slowly getting rid of this amount from their estate. That kind of also ties into that tax planning strategy. And of course, capital gains tax, we're back to the whole step up issues and basis issues. Again, we want to minimize any types of capital gains to the extent we can, and to maintain our basis for the assets that do have that are one of those low basis assets. We want to make sure that those stay in the estate so that they do get that step up.
Yeah, the only thing I would add to that is, you know, if somebody comes across our firm with a profile like this, again, built a portfolio over 30 years, has done really no planning, has been under-advised. There's so much opportunity, both on the income tax and the estate tax side. It's really about prioritizing which bucket you want to put it into at an 80-year-old age, and with exemptions going away, that's obviously, you know, right there at the top of the list to make sure you use up those exemptions and implement a plan that makes sense going forward up front. But even on the income tax side, one of the things that draws me to real estate is that there's usually a range of right answers when it comes to taking deductions, when it comes to, again, estate planning. It's not, you know, there's a lot of gray area when it comes to you know, managing taxable income overall. And people that fit this profile usually have some pretty big opportunities to accelerate income through you know, strategies like cost segregation. So if it makes sense to have even taxable gifts in the current year, maybe there could be an offset against that with regard to harvesting some tax losses that have been sitting there through doing cost segregation studies on existing properties within the portfolio. So it's very holistic. And for most people that, again, fit that profile with multiple properties, a big portfolio, there's opportunities for us to mitigate, both current and future, whether it's income tax, gift tax, estate tax, through utilizing strategies within each one of these assets. There's usually a large menu to choose from. And it does go back to, coordinating the CPAs with the attorneys and the trustees on all of these accounts to make sure we get to the right objective. But usually there's a very big pond to fish from. I'll say.
And to Scott's point, I mean, for those who have used their exemption amount, there's still opportunities. I mean, we have so many part sale, part gifts. We oftentimes do with family promissory notes that we forgive on death. All of those are different ways that we have clients who, they're willing to pay some tax just to take advantage of some of the discounts. So it really is a huge menu of options. And for someone who is, late in his life, there is a lot of missed opportunities, but hopefully that happens before he passes away.
Well, excellent. So let's move on, sake of time here. Let's move on to this next slide here and talk about this concept of an action plan timeline. Della, would you like to share some thoughts around, you're often the lead fiduciary team lead, that this would be that point of interface for the family.
Okay.
Kind of unpack this a little bit. I know fact patterns matter, right? Of course, but
right. And to that, Charles, that's why when we last discussed this slide together, all of us, we added the client goal setting as number one. And that's because that is fact matters do matter. Clients all have different goals and different things that they care about most above all else. So it's important to take that into consideration before we decide to give them the toolboxes of options. On that timeline, though, that again, we're talking about short terms, things that we want to do quickly, get the team together and have them set those goals and see exactly what the principal and the family wants. In my case, of course, I'm updating the estate plan and reviewing the related entities. And I want to make sure that the properties are structured correctly. And in my case, oftentimes I see property titling as an issue itself. Many clients come here and they think that their, the real property that they own are in those different entities they've created, only to later find out that the funding was not done properly. And we're going back just to make sure that the titling gets corrected. That's major to review before, God forbid, any type of death happens. And then, of course, we want to make sure that the will and the trust, they incorporate more modern techniques, dynasty trust, and that it allows for the wealth to transfer across the multiple generations. I mean, I've spoke about a couple more of the other things, which is the estate tax exemption. We want to take opportunities to do those types of gifting. And I don't know if this touches into any of the others. Oh, maybe I've already done my part. So I'll let you guys take it over before I talk too much.
This is great. So I want to pivot to our next slide and kind of close out this case study, Andrew. So this whole idea of the goals that are leading to all this, right? The family wanting a smooth transition, providing peace of mind for the principal. These are important drivers, right, for these decisions that are being made. Would you want to speak to this and kind of, again, that whole thing I asked is, do you start with the end in mind? Obviously, it's driven different ways, but this is the end outcome that we're looking for.
I mean, you have to think about, it's a little bit of a dog bone. You want to have to think about the beginning and the end in mind all at once. Some of this also is planning and how you maintain a plan over time. And part of that, and so with some of our clients with sizable portfolio, we'll sit with them and review balance sheet and investments on an annual or semi-annual basis. What that does is, as a corporate trustee, when we're not serving the assets, maybe in a rev trust at that point, it allows us to pick up exactly where this decedent would leave off. Means we're aware of the assets, we understand the liquidity, we understand the financing, we understand the business plan. And that is a type of maintenance that, especially with a sizable portfolio, is quite important. The other thing is just knowing who is involved. Very often you don't really have necessarily a picture as a corporate trustee who is involved in all of the entities. And that's very important, whether they are additional investors or whether they are partners or managing agents or other parties who are involved. On a planning basis, as Dana had mentioned, titling is extremely important, and understanding that the properties are either titled properly into the entities, or the entities are placed into, for instance, a rev trust, or the properties are titled into the rev trust if it's done directly. One of the other things that is becoming very complicated these days is the rules around LLCs and disclosure of beneficiary interest have become a major issue that takes forethought and management. So those disclosure rules are making the role of a corporate trustee much more complicated, especially with assets of this type.
Great. All right, well, thank you, Andrew. So we're gonna move, sake of time, on to our next topic here, and we want to just close this out, just kind of talking about, we opened up talking about the holistic approach more generally, and now we're looking at some of the advanced considerations, and also a key thing around maintenance of the portfolio. So, Scott, would you want to just kind of briefly touch on some of these these considerations and advanced planning strategies?
Yeah, and I'll be brief just for time to make sure we have enough here at the end. But I mean, overall, a lot of these things are things that we've talked about throughout the course of this presentation. I mean, I think the one thing that people really need to make sure they understand before they enter into these transactions are that gifts are permanent. They can have an impact on your ability to access those assets going forward. It can have a change in effect on the ongoing business, the underlying business that, presumably is still trying to be built around the real estate within the portfolio. So it's very much a coordinated effort. Again, communication and education with regard to the taxpayers that are going into this. And then also with regard to the trustees and the beneficiaries of these trusts going forward, to make sure that, that a lot of them are set up to go through multiple generations. So making sure people are educated as to what those rules are, so they don't go off the rails as far as maintenance going forward. I think Andrew hit on that previous slide. And I probably won't go too much. I don't know if we have any Q&A coming up, but I know we're coming up on time. So that's probably a good summary there to.
All right, thank you. And this last, any comments about maintenance? I know that was a key thing that we wanted to touch on, just maintenance of the actual real estate portfolio and key considerations there. Andrew?
Yeah, I guess maintenance ahead of time. One of the things that most real estate investors do is they love investing in real estate, and so they will do deals very late in life. They may be, as has been pointed out, be a guarantor. They may be buying new real estate that is not actually folded into the planning in an efficient way, and it's very often what we find stray assets, so to speak, where there are additional assets that have not been considered. And in the estate, you wind up identifying them. They're not necessarily coordinated. So, if you have good planning, that is not static. You need to continue to maintain it and ensure that new investments or old investments that you've sold come out of the planning. and that you refresh your thoughts on what you're doing on an ongoing basis until the plan becomes effective upon death.
Right. All right. Well, thank you on that. So, Jeff, I think we got to our time here, and I know we had talked about having a few extra minutes for Q&A. Do we have any questions that have come in?
Yeah, we have we have a couple, and I want to thank BDO as our co-host on this for CCIMLA. We really appreciate you putting together this panel. We obviously have an exceptional panel as well. I want to thank all of our professionals on the panel, Scott, Della, Andrew, and Charles for putting this together. As hopefully the audience can see, this is a very dense topic that is hard to get through in an hour. There's so much to get through, and there's so much to talk about with regards to real estate. One of the issues that I see in the work that I do with clients is this conversation around structuring. And one thing that I'm curious about, and maybe Andrew, you could opine on this first, is a lot of real estate owners, they get started as syndicators. They get started putting together these limited partnership interests, acquiring these pieces of real estate. And over the evolution of those LP, those operating agreements, you have a succession with LPs, you have succession with the operating agreements. What are some key things and key ways that you see syndicators of real estate kind of plan for as it relates to succession, and all of those things? I mean, I would imagine there's so much complexity associated with these different entities and capital stacks.
Yeah, they are, and it depends on what you're doing. If the intent is, many LPs look at those assets as their assets, despite the fact that there is a group of investors, and the issue is, can you take that asset and have it roll downstream? If it's sitting and being run by an operating company that you have, the answer is you may be able to actually do that. Because you'll have a successor in the corporate entity that is operating them, and then it's really not flowing down through your estate. If the intent is to try to hold on to that asset with outside investors and put it, say, into trust, it's probably a bad fit. And the issue, there are multiple issues, including finding a corporate who would actually sit in that role, because the corporate will wind up with a fiduciary responsibility to all the limiteds, and it's a very uncomfortable place for them to sit. Most fiduciaries, I would think, would be very reluctant to do that. Many corporate fiduciaries, in any case, are reluctant to touch investment real estate or large amounts of it. Because of some of the skills needed, but also the liabilities associated with the role.
That's great. Thank you, Andrew. I appreciate that. And one other question here, I know we're running out of time, but Della, from your perspective on, multi-generational communication, what are some best practices or ideas, particularly with real estate, because it is an asset class that requires a lot of operations and active management. What are some best practices as far as communication across generations when first generation is building their estate and its succession plan? Should they engage with the next generation during that process? How early and often should they start having these conversations around succession, operations, particularly with real estate?
Yeah, yes, early and often. So the ones I've seen be most successful are the ones where the succession is the dialogue is very open between the family members, and that they really are taking the time up front and maintaining that kind of the portfolio and continuing the open dialogue. I can't tell you the number of times I have had clients who have those handshake deals that then the next generation has no documentation of, and those are by far the most conflict causing issues. So when I think about best practice, the extent to the extent that they can, I do believe that getting the kids and getting the adult next generation involved is to the advantage of everybody. And that also plays with the fact that we often have roles that need to be replaced as our children get older and as the children kind of, I want to say, like, they prove themselves. So continuing that maintenance, that to me is key. And besides that, I mean, this holistic plan that we speak of, getting all the key players to be, all the advisors to be on the same page, and having the direct communication, open line between all these key players, that serves, that serves to cut down any issues with so much.
Thank you. Thank you.
One of the things, and you touch on a good point, one of the things that we see quite often is in succession within families. Either the person who believes that she or he is going to be the successor is not, or there are people who are involved in the direct operation of the properties, say in an operating company, and responsible for the leasing and the management of those properties. And then there are those members of the family who are off doing something else and living their lives. And that is a setup, if not carefully thought through, for conflict in a future generation, a misunderstanding of why people are compensated the way they are, and a misunderstanding of who actually should have control and how that control works. And so one planning consideration that is very important if you want the portfolio to survive over generations is understanding how transfer control within the family happens and how those responsibilities are maintained. And then a methodology of resolution of those conflicts without employing too many lawyers.
Excellent. It's always the thing we're working to avoid. Not that we don't need lawyers, Stella, but
need a lot of them.
The other thing, and so we're going to let it go to 12:10. I just want to. There's a couple more questions, or one or, and then Charles, I know you got one or two here, but maybe you can speak on the importance. A lot of the real estate families that I end up working with, they end up kind of going to estate planning first, and oftentimes I talk about the importance of getting organized and getting kind of all of your ducks in a row, understanding what you have today, so that you're not making Della and the rest of the team kind of dig through and try to find all the skeletons and where all they're buried, using the Halloween analogy. So what are some best practices around getting organized? Also, the ROI of that is you don't have to, have the attorney or your other advisors, spending time, energy, and money, trying to find those things. So what are some best practices that maybe just a couple that you can talk about in terms of the benefits of getting organized on the front end before you start this work?
Anyone in particular you'd like to address that, Jeff?
Or no one.
Scott, would you want to jump on that one?
Yeah, you want to go?
I mean, I think you nailed it. I mean, the more organized things are, and the more the easier it is to communicate either the structure or the intent of whoever's entering into this planning, the smoother that it goes. That's always going to be an absolute truth. It'll minimize the cost, the number of hours that go into actually executing a plan, as opposed to sifting through it. So I don't know if I'm fully answering your question, Jeff, but I think it's more about, I absolutely agree with your approach.
And again, don't tuck it in a drawer, keep it live, change it, update it, and have a plan to update that. So if you're going to do it annually, and make sure that it's still right.
Excellent. Charles, do you want to go with any final thoughts, questions?
No, I just wanted to thank everyone for joining us here and working together as a team to put together this event. I think it's turned out really well, and I hope it seemed like it was well received. So I want to just thank everyone for their participation and involvement.
Yeah, thank you, everyone, and would encourage you again to reach out to any of our professionals, any of our panelists, and we appreciate all of your attendance and look forward to seeing you at the next one. So with that, we'll stop the presentation, and again, appreciate Appreciate your thoughts. Okay, so let me